equity-like bonds, what's the deal? Instead of using the futures, we use TLT here because it'll apply for more people. Personally, before we get into this piece, TLT is fine. I even made a TLT trade already this morning.
Smaller product, right?
Yeah, TLT is like it's a long-term. It's a basket of bonds, 20 to 30 years, 20 to 30 years in duration. It acts like ZB. It's about 1/10 to 1/12 the size of a ZB contract. So if ZB is too big for you, it's about 1/10 to 1/12 the size. It's a little less liquid. For sure, it's less liquid, believe it or not. But the other side of it is if you want something that's very, very liquid, that's half the size of the bonds, there's the 10-year note, which is /ZN. I trade way more ZN and ZB than I trade TLT, but I do trade them all. I'm only putting that out there just because you don't have to trade TLT on this piece. You can use ZB or ZN. And they trade...
Sure, get as big or as small as you want.
Yeah, they trade 24 hours a day, 5 days a week, starting on Sunday night all the way to Friday night. So, and again, ZN is half the size of ZB. Contract size is the same. The tick size is half, and it moves half as much. Like today, ZN's up like a half a point, and bonds are up over a full point. So it's a very different animal. With traders increasingly focused on tariffs and their implications, bonds have become a hot topic. What key characteristics of bonds should we understand, and what opportunities might they present? I mean, if you've been watching this show, we've been talking about buying bonds for the last month and a half, and they haven't gone anywhere to the upside. They've basically been selling off for the last month. And we're just kind of like, this is a total, hey, we're just hanging in there. We're just holding the position, and eventually you get paid. And today, hey, you know what? You got paid. We're not playing it as a tariff play. We're not playing it as a geopolitical play. We're just playing it based on price. And the bonds, in my opinion, have been cheap. They got some upside. We'll see what happens. Bonds have experienced one of their highest periods of implied volatility in their history, with the IV ranks and performance mimicking equities this year. Usually bonds trade maybe a half to 3/4 the volatility of equities. This year they've been kind of on a par. How is selling premium in the bonds fared historically, and especially since 2025? What's interesting about bonds, and we hope to prove in this segment here today, is that if you want to trade bonds, even though you say, I don't really know what those do, I don't understand them, I don't this or that, it's no different than trading Tesla. It's no different than trading Microsoft. It's no different than trading any other instrument. They're all the freaking same. I mean, they have a different, there might be a different reason for wanting to be, you might have a different reason or a different assumption for wanting to be long or short them or how you want to trade them. But there's no difference in how they perform and how they trade from if you wanted to trade S&Ps or if you wanted to trade bonds. If you want to trade bonds or you wanted to trade IBM. Okay, there's really no difference. We're going to prove that to you. Let's go to the next slide. So we did a study. We looked at TLT, so everybody can look at it, from 2015 for 10 years. We looked at 10 years, 5 years, and 1 year. Sold 25 Delta Strangles, 45 days, managed at 21 days. Compared the results since 2015, since 2021, and for the last year. Looked at the average P&L, the win rates, the average credit, the worst loss, the average return on capital, and CAGR. What does that stand for again? Help me here. CAGR. Well, I'll tell you in 2 seconds because I don't want to mess this up. Cumulative average growth return, something like that. Well, I'll look. We have it in the study. I just forgot what the acronym stands for. Let's go to the next slide.
Not 100% sure.
It's
growth rate. What's the difference between the growth rate?
Yeah, we'll show you in a second.
Compound annual growth rate.
That's what it is. Compound annual growth rate. Economists, we are not.
No.
Hardcore traders, yes. Economists, no. The shape of the distribution of P&L since 2015 looks bell-shaped with downside skew. All the other short strangle distributions look similar, regardless of the underlying. So basically suggesting that before you go off and think, oh, the bonds have had this crazy move or this or that, you know what? They're really no different than anything else that's been out there. Nothing, no difference. Nothing, honey. This is 3 different periods: the 1 year, the 5 year, and the 10 year. Let's go to the next slide. Okay, this is where things start to balance out. So looking at the results in detail, the key is to see that not only the win rates remain the same, but also the average credit divided by buying power, the average P&L, the average return per trade also remain very close to the same, regardless of the time frame. So again, the bar on the left is 10 years. The bar in the center is 5 years. And the bar on the right of each of these graphs is the last year. When you start to look at it, you realize, you know what? It really is just a game of IVR. When the IVR is high, you put these positions on because it's no different than trading anything else. And this is an incredibly liquid future. The 10-year notes are the most liquid future out there. Like when you think S&Ps are super liquid, they are, but the 10-year notes trade more than the S&Ps trade.
Yeah, which a lot of people don't realize. You're 100%
yeah,
correct.
and the markets on the options are 1 tick wide. So they're literally 1 tick wide. Now, 1 tick in there is big. It's bigger than, but remember, it's 1/10. It's 10 times the size of TLT. Let's go to the next slide. So despite a slight variation in the worst loss, the compound annual growth rate, that's what I was looking for before, the CAGR, which measures an investment's average yearly growth over a given period, remains virtually the same as the win rate. That's interesting. It's also a good takeaway, because essentially you're not giving up anything to the field. That's the takeaway here. You don't have to look at something on a 10-year basis or a 5-year basis, even on a 1-year basis. Everything's solid in a tough year. Now, would we have done better this year if we traded bonds both ways? Yeah, for sure. But I've only traded them to the upside. So we've actually left some money on the table. What this study is saying is that if you'd done both sides, Tony, you would have done better.
Sure.
Of course, because they've been down most of the year and we left the call side off.
Right.
I mean, it's common sense, but I thought there could be a big rally in the bonds, and there just hasn't been yet. Maybe it'll start now. Let's go to the next slide. And there's no rhyme or reason also for knowing when this stuff starts. Like you could say, oh, you should have just waited till they were up. Well, if you waited till they were up today, you'd be buying them now. So it's tough. It's really tough. I mean, bonds traded 111.5 2 days ago. Now they're 113.5, and they're 2 points higher. That's $2,000 per bond.
Sure.
So despite abnormally large implied volatility and movement, short premium in the bonds has recently performed virtually the same as it has over 15 years on average. When looking at the win rate, the average credit, the average return per trade, the average P&L, and the CARG. Since short strangles share the same, that's a lot of S's. Since short strangles share the same characteristics throughout nearly all underlines, the results,
followed by a C too. I mean, the whole sentence is really good there.
The results of a strategy in one liquid underlying generally can be used to estimate outcomes in another, essentially suggesting what I said to start off, that if it's a liquid underlying, okay, it doesn't really, that's the great thing about this business. As long as everything's liquid, you can pretty much pick your poison. If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.